Okay, so MCTO, monthly cash through options. We have a few newsletter services. We have the IC1, that's the Iron Condors and Credit Spreads. I'm the chief publisher for that. I'm Brad. It's an income generating and non-directional strategy. We primarily sell far out of the money calls and puts that expire in 30 days or less, and these are all 87 to 91% probability trades. Primarily focus on the SPX, NDX, and RUT indexes. That represents the S&P 500, the NASDAQ 100, and the Russell 2000. The objective is to hold spreads that we open until expiration, where they will expire worthless for the buyers and they'll be 100% profitable for us. So when we open these up, we collect premium, and the goal is to keep that premium. And we have a third newsletter that we're launching in Q4 of this year. Amir Atabaki, he's the chief publisher for that. It's called Theta Decay, Iron Condors, and Credit Spreads. And this one also, it's income generating and non-directional. It's focused on the SPX, NDX, and RUT indexes. And this one are longer dated credit spreads and Iron Condors. So he sells 60 and 90-day far out of money calls and puts. And he also round trips all of his trades. He opens them, and then within 30 to 40 days, the objective is to close the spreads early and to book a 40 to 70% of the profit of the premium collected as profit. So for more information on the Theta Decay Iron Condor strategy, you can contact Amir Atabaki directly, and his email address is amir@monthlycashthroughoptions.com. Okay, directional versus non-directional. Directional trades, such as straight calls, puts, debit spreads, at least on kind of the disadvantages of them, is they take a lot of time, a lot of research. You need to open the trades, open the stops, manage the stops, replenish the trades that stop out. You can get quite a bit of anxiety generated from trades that go the wrong way, so people who do directional trades really need to be able to handle that anxiety. In general, a directional trade will lose 35 to 50% if it does stop out. One advantage, risk capital, is the initial debit, so stop losses will control that level of loss. But overall, it takes a lot of experience and focus and time and effort to make consistent long-term gains with directional trading. Non-directional trades, such as index credit spreads and Iron Condors, that's what I focus on, that's what Amir focuses on. They take about 3 hours per week. That's when you're leveraging the strategy that in our newsletter that we send out each week if you're doing self-managed. About 7 months of the year, I would classify it as easy money, and then the other 5 months take a little more work. And then a few of those months, they could possibly be losing months, and we'll be rolling those trades, and they take a lot more work. But that's just the way it goes with any of these trading strategies. Periodically, we will have to work hard to either keep the account flat or keep our losses under control when we're going through a tough month. So our trades last usually 15 to 30 days, at least what I focus on, and that's the primary objective of this presentation. I'm focusing on IC1, that's Iron Condors and Credit Spreads, and I focus on 30-day or less credit spreads. What's nice about non-directional credit spreads is we achieve monthly results. Historically, we're showing 20 to 35% ROI annually, and that does include reserve cash. So for like the auto traders, they have 25% reserve cash sitting in the account. It's doing nothing, and we do take that into account when calculating the ROI. Disadvantage of credit spreads is that when you're wrong, the losses can be large if you don't know what you're doing. Okay, here's a track record of the IC1 service. And I've been primarily doing this for about a decade now, since 2004, 2003 is when I really got started with credit spreads. And I just naturally gravitated to selling options versus buying options. And that's just what I liked, and that's what I just stuck with. And in general, when we work with traders and hire traders, we just try to find someone that gravitates to a certain strategy, something that they're passionate about, and then they tend to, really focus on it and get really good at it. And for me, I just really liked non-directional, strategies that just generated profits and or at least generated results on a monthly basis. Okay, 2014. You're going to see it's been a little rough. We've gone through a rough patch in July and August. September is probably going to be flat, so we're starting to regain our footing. Traders will go through some tough times periodically, and I've been experiencing it in the last couple of months. But you can see I've been doing this a long time, and we will see some losing months periodically. The objective is keep the losing months under control. My definition is keeping it under 5%. So when I'm over more than a minus 5%, then we're not too happy about that. We're really digging in, doing a lot of post-mortem, trying to figure out what we have to look at differently to see if we can keep these losses better under control. We're not going to win every single month. Again, keep the losses under control, and then when we start booking the profits, we can usually show a handsome return at the end of the year. So if you want to talk more about the Iron Condor strategy returns, the ROI, on the website we show all the returns, all the trades, all the winners, all the losers, how we adjusted the trades, especially the losing trades. And then you can give us a call, and we'll be willing to dig into the returns and dig into a particular month, and we can talk about all the different trades that we made and all the adjustments that we made. If you would like. So we're wide open to discussing all past trades. Okay, directionals versus non-directionals. Kind of at the big picture, we really recommend to do both. In my personal opinion, as I work with clients, I'm recommending about 25% allocated to directional trades, 35% allocated to non-directional trades, like what I do, and 40% right now allocated to the broad market. Broad market is still trending up. We're still in the long-term confirmed uptrend. The Fed is still very easy with monetary policy. Quantitative easing is being wound down and it's going to be finished off by this year, but the market likes what it sees. The economy is expanding. Macroeconomic data is expanding. Corporate earnings are expanding, so the market still is going up. So when I say 40% allocated to the broad market, one could buy the SPY ETF. The SPY represents the S&P 500 index, and that's probably the easiest way to get broad market exposure. Now, that's only when the market is in a confirmed uptrend. And in our analysis and our weekly advisories, we show the data that reinforces the fact that we are in a confirmed uptrend, and we watch that from week to week to week. The minute that looks like we're getting choppy and toppy, and especially when we see certain technical indicators, or especially a deterioration in macro data or earnings data, then we'll immediately, pull back on any type of broad market exposure using the SPY. But right now, you can add to that position during pullbacks. Advantages of doing both. Now, when we say both, I mean both directional and non-directional trading using, for example, the MCTO services. Directional trades work well in trending markets, of course, and non-directional trades work well in sideways and choppy markets. And we are getting to the point now that this market's not just going to go straight up. We're going to get times of choppy, sideways trading, and that's when we can definitely shine with the iron condors and credit spreads. Okay, 90% probability index credit spreads and iron condors. Well, what does 90% mean? 90% means the probability that it will expire out of the money and expire profitably. 10% probability that it won't, and that we're going to have to make an adjustment, and the losses can build up pretty quickly with these types of trades, so you have to know what you're doing on adjusting these trades. These are also known as wide-mouth iron condors. Historically, they tend to produce reliable monthly returns. We will have 2, 3, possibly 4 losing months out of the year, but in general, when you add it all up, we can make returns, positive returns. Indexes are naturally diversified because they have hundreds or even thousands of companies within that index. And what's nice about it then is it eliminates company and company and specific and industry-specific risk. So, for example, CEOs accused of cooking the books, whether in the company that we have invested in or another company that's in the same industry segment. That is company-specific risk or industry-specific risk, and that can really nail you if you are working specifically with companies. CFO unexpectedly steps down. Closest competitor announces a big loss. So things like that, that's basically company-specific and industry-specific risk. By using indexes, we can eliminate that risk. Writing credit spreads is like being the house in the casino. We make a little on both the bullish and the bearish bets. Okay, so let's talk about really how to make consistent monthly returns with credit spreads and iron condors. Step 1, learn the mechanics of building the trade. Step 2, monitor big picture indicators. Step 3, focus on just a few underlying vehicles. And step 4, know how to adjust when trades get hit. We're going to focus primarily for this presentation on step 1 and step 4. We're going to dig into the mechanics of building the trade and the mechanics of adjusting a trade. And then if we have time, we'll touch on step 2 and step 3. Okay, the iron condor. This is a risk-reward graph, and this is the modern version of it, interpretation of it, where it's kind of flipped on its side. I can see the underlying index on the left side. For example, this is the RUT, R-U-T, Russell 2000 Index. This black horizontal line represents the closing value of the RUT index on this particular day, which was, this is kind of an old graph, but does the job, 525.07. And we can see that this underlying opened at this value. That was the high, that was the low, this was the close, and it closed up plus 6.13 points that day. Again, this is the closing value of the underlying index. This represents an iron condor, and we'll get into more details of how we built this. Right now, just at a higher level, this represents 2 calls. We basically sold the 890 call. We sold the July 07 890 call for $2.10. And we bought the July 07 900 call for $1.50. That creates the top bear call spread. And then for the puts, we sold the 760 put, and then we bought the 750 put. Okay. This creates the iron condor. So let's dig into let me spend a little more time in this risk-reward graph. The lines represent our profit and loss as a function of time. So right now at 55 days out, for example, when we first opened this trade, like for example, we bought, sold, and bought these contracts. Okay. And each one is open for 55 days before expiration. All right, so at 55 days, we're on the red line. Underlying is right here. Here's the value of the underlying, and the red line is basically telling at 55 days out that this trade is down $100. So this must have been, we opened this up a couple days ago, so usually when you first opened up the trade, you'll see the line right on the 0 line, meaning you first opened up the trade, you have a 0 profit and a 0 loss. And now the value of your iron condor is dictated by these lines. So at 55 days out, you are on the red line. About 31 days out, you're going to be on the blue line. You can see that the line's moving over. And then at 0 days, representing expiration, you're going to be on the black line. And that is the day of expiration. And if the underlying, in this case the Russell 2000 Index, expires below this point and above this point, you keep this dollar amount right here. This represents the credit that you brought in when you first opened this trade. So you brought in about $1.40 of credit, or $140. You multiply everything by 100 because you're controlling 100 shares of stock, or 100 shares of this index. So when I first opened this trade up, I brought in a credit of about $1.40, maybe $1.30. That was my credit. And that represents $130 that was deposited into my account. And within 55 days, as long as this index expires below this short call, in this case, the 890 call, and as long as it expires above the short put, in this case, the 760 put. Okay? That's how you read the risk-reward graph. Okay, if you want more information on how to read a risk-reward graph, please go to this address here, www.monthlycastrewoptions.com/risk-reward graph, and put a dash between those words, risk-reward graph.htm. And I show this picture here. And so it's pretty much the same risk-reward graph, just a little more detail, but pretty much the same information. And we show this picture also, showing an iron condor, little arrows pointing to all the numbers. And what this is a options analysis package from Optionetics. So this is the platinum option analysis package. That's what I'm showing here. And that's what I learned using that back in 99, 2000, and so that's what I still use when I build trades. For iron condors and credit spreads, once you understand the concepts, you don't really even need to build the trade anymore. So I rarely even use platinum, at least for credit spreads and iron condors. I only use platinum when I'm working on new types of trades. Okay, and if you don't have access to this address or you're not writing it down, just send an email to support@monthlycashthroughoptions.com. Monthly cash through is THRU. Monthlycashthroughoptions.com, support, and we can send you this address. Okay, let's just build a bear call spread first. So, for example, we're going to build that. That is the top of the iron condor. Okay, and let's see. Okay, so let's build the top of the iron condor first. This is a call. Okay, so now we just learned how to read this risk-reward graph. Down here is profit and loss in dollars. If I just were to buy a call, bought July 07, 850 Russell call, I pay $13.70 for it, or basically 1,370 bucks. I buy a call, and this is what it looks like. Here's the 850 strike is right here. At expiration, this is what the line looks like of how much I made or lost. Here's the underlying here, and here's the black horizontal line representing the closing price of the underlying index that particular day. When I'm 55 days out, I'm on the red line. When I'm 37 days out, I'm on the blue line. So for example, let's say that I'm on the red line, and the following day this Russell index pops up to, way up here, like 860. All in one day. Well, guess what? My call is now worth, I go over to the red line and drop down, my call is worth $1,500 of profit. That's my profit. Let's say that we're almost close to expiration, so we're almost getting close to this black line, and let's say our index didn't move at all. It stayed right there. I paid $1,300 for this. Yeah, $1,370 for this option. So there's the amount that I paid, $1,370 here, and I bought it and I held it all the way through expiration. What that tells me is that what this graph told me is that I just lost $1,370 because on expiration, time decay ate away the value of that option that I bought, because I bought the July 07 850 call, and when it expired, I basically lost all my money. That $1,370 is gone. Okay, so that's a call. If I were to flip it around and sell this call, so I'm going to sell to open the July 07 850 call, then this is what it looks like. So I sold it, so I brought in $1,320 worth of premium, and so this shows here that as long as this underlying stays below this strike, 850, all the way to expiration, I pocket that $320. Okay, and that's going to be my profit. If it goes up any higher than that short call that I sold, now I'm losing money, and now I'm going to be over here, over in the left side, which is all losing, minus 1,000, minus 3,000, minus 5,000, and it's going to have unlimited loss. Okay, so that's selling a call. Now, if I were to combine those two, where I sold a call and then I buy a call, it creates the spread, and that's a bear call spread. And it protects me. So there's 10 points between the short leg and the long leg. The short 850 call is here. The long 860 call that I bought is here. 10 points between those two strikes. The most I can lose is $1,000, or 10 points. Okay, so at least it puts a protection mechanism in place because it caps my losses. So that's a bear call spread. That's a credit spread. And this is the building block of an iron condor. We start with credit spreads, and we will open credit spreads at a time. We rarely open the entire iron condor. And in this case, again, I sold the 850 call. I bought the 860 call, 10 points between the two legs. There's $1,000 of risk. So when I open this trade, the broker is going to lock in $1,000 of maintenance. They're going to hold $1,000 of maintenance, and they're going to hold it until this trade is done. In this particular case now, I brought in $350 of premium, and this is going to be my potential profit in this particular trade. If the index stays below this 850 call through expiration, we have 55 days to wait, then I can keep that $350. Okay? So that's a bear call spread. And then, now this is a typical bear call spread we would open up. We would just push it up higher. See, this one's a little tighter. I would open up something a lot higher. So I'm selling like an 890, 900 bear call spread. The index is way down at 830. I give myself a lot of room to be right. It's still open for 55 days, but my premium is less now. I only brought in $90 of premium. Basically what I bought it for minus what I sold it for, these two legs. That's the difference. That's the premium or the credit that I brought in. This is my potential profit. If this index climbs up here and before expiration, now I'm going to start losing money. And when I'm 55 days out, I'm on the red line. When I'm 37 days out, I use this blue line that dictates and tells me how much I'm making or losing. Okay, that's a bear call spread. Okay, the put. On the put side, let's move a little faster. I'm going to buy a put. This is bought the July 07 790 put. Here's the strike 790 put. Right now the underlying is up here around 830. And I'm going to pay $9.30 or $930 for this one put. And this is my risk-reward graph that tells me how much I'm going to lose or make. If the index stays up here, when you buy a put, you're betting that the index is going to go lower. In this case, let's say, for example, if the underlying stays right at this level, 830, and doesn't move for 55 days, then I'm going to lose what I paid for this option, $930, and you can see it right here, minus about $930. That's what I lost. If I was right and this underlying started dropping, I'm making money based on this risk-reward graph. Okay, that's a put. If I were to sell the put, it's the opposite. I'm going to sell it for $8.80, so here's my potential profit over here. That's about $880. If this index doesn't move for 55 days, I keep this premium, $880. If it does and it starts dropping, I start losing money. And this is an unlimited loss. So when you add both a short put and a long put together, you create a bull put spread. This is a credit spread because what I'm selling for is more than what I'm buying it for, these two different legs here, the 780, 790 leg, 780 leg, 790 leg, 780 leg. I get a credit. When I open up this trade, that's what I can make. That's my potential profit. In this particular case, it's about $110, or I brought in a credit of $1.10. And my bet here is that this index is going to stay above the short put strike. All right. So now let's take a bear call spread, add it to a bull put spread, and we end up with an iron condor. Okay? So that's the entity of creating an iron condor. It's really not too difficult to open these trades. That's the easy part. The hard part is this timing of when you open these trades and then how to adjust the trades that go against you. But just on the mechanics of opening the trade, it's really not that complex. Okay, some trading rules. We open up 90% probability trades. By the way, this is for the rut. The delta of the short leg, which you find in the options chain in your brokerage account, represents approximately the probabilities of that trade expiring out of the money. So you'll see a delta of 0.1 or 10, 0.11, 0.12. That's basically telling you that's about a 90 or an 89 or an 88% probability trade. So we're 30 days out or less, enter a trade with 60-point put cushion. The delta we're shooting for on the short leg that we're selling is around 9 to 11, 0.09 to 0.11. Shoot for 45 to 65 cents on the top for the bear call spreads and about 55 to 95 cents for the bull put spreads. If you start getting more aggressive than this, you're going to be getting hit a lot more. And you don't really want to be hit more than 3 times a year because it's a lot of work. It's a lot of work, creates anxiety, you get losses, and it gets a little painful. Slowly collect your fills over a few weeks. Watch upcoming economic announcements. Watch the calendar. Watch when the Fed is meeting, things like that. Use 10-point spreads, at least for the rut, 10 points between the short leg and the long leg. We open up bear call spreads on the up days, open bull put spreads on the down days in general. But you know, this is a lot longer of a discussion on how to time when to open the bear calls and when to open the bull puts. So for example, when you're in a trending market, and recently this market wants to go higher, you have to be really careful on the timing. Don't get greedy, keep the safe zone wide, keep on using 90% probability spreads, meaning if you shoot for this in this range, that 45 to 65 cents on the tops and 55 to 95 on the bottom, that's kind of a natural protective mechanism, and it's giving you about 90% probability trades on average. One more thing when we say open bear calls on the up days and open the bull puts on the down days. What we're saying is that on the up days, the bulls get excited. Line up 100 investors. You're going to have a certain percentage, let's say half are bulls and half are bears, let's say. So on the up days, the bulls get excited. They want to buy calls. So we will open our storefront and we will sell them the calls. That's what we do for a living. Okay. However, the calls that we sell them are not really desirable. We sell them far out of the money calls and they expire in 30 days or less. In general, when you go take lots of classes on options, when you, at least with regards to buying options, the first thing you learn is do not buy an option that has less than 30 days to expiration. In general, you want to buy options that have 90 days, 120 days. You want some time to be right, and it's worth paying more for that luxury of time to be right. So we got people on that buy our calls and puts that, you know, these options have 15 days, 10 days, 5 days, and people are still buying them. So, you know, whatever the reason, they will buy them and we will sell them. So we're selling rather undesirable calls and puts. On the down days, the bears get excited. So the bears get excited. They want on the down days. They want to buy puts, and so we'll open our storefront. We'll sell puts. Okay. Okay. Here's the bad news for credit spreads and iron condors. Mathematically, this type of high probability trading is a long-term losing strategy. Mathematically, so you have to work at it to make it work. And that is so mathematically, if you just try to automate this just using math, you know, technicals, just write a program and you're just opening up credit spreads every 30 days out, your account will be zero within 5, 6, 7 years. It's just, that's the way these things work. So you have to kind of finesse them, you have to time the market, you got to watch a lot of things, and then you can make them work. So we can make them long-term profitable if we follow many more things and we move, sway, and time the market. Okay, so how to make consistent money in these things. Step one, learn the mechanics of building the trade, which we covered. 2, monitor big picture indicators. 3, focus on just a few underlying vehicles. And then 4, know how to adjust when we get hit. So let's jump to step 4, since we're going to focus purely on more of the kind of building the trade and adjustments of the trade. And then if we have time, we'll come back to step 2 and step 3. Okay, so here's well, we're showing an iron condor. What I say is how to adjust a bear call spread, but we're gonna make this one so this one the top starts getting hit. So this is the iron condor, and right now we're showing an SPX, which is the S&P 500 index. This is a 1520, 1530 bear call spread. So we sold the 1520, bought the 1530. For the bull put, on the same thing, same underlying, SPX, we sold the 1340 and put and bought the 1330 put. That creates the iron condor, which you know a lot about now. Here's the underlying index. This is the SPX as a function of time. This is in 2006. So it's showing this going back to like January 2006 through, December 2006. We open up this trade, and 2 weeks later, 3 weeks later, it looks like this. Okay, the top bear call spread is getting under pressure. It's drawing down. We brought in a certain level of premium for this one. We brought in maybe 80 cents. We brought in maybe 60 cents for the top one, but now it's telling us that we're in a major losing situation right here where it's probably going to cost you $2.50 to buy back that top spread to close it out. So you brought in 60 cents, but it's going to be, let's say it's worth $2.50 to buy back. Instead of buying it back, which you can, that is definitely an option. Okay, you could buy it back and close it out and take your lumps and move on, or we can try to adjust it. So this is the standard adjustment that just really works, and so I just use it a lot. It keeps things simple. It's not super complex. It's basically rolling out and up. As long as our analysis is telling us that there's a reasonably average probability that this thing is just going to keep on rocketing higher, we'll just roll it out and up. We'll keep it as a bear call spread. Right now we have the 1510, 1520 call. And I'm going to buy to close that 1510 call. I'm going to sell to close the 1520 call. And this is a four-legged order, all in one order. And then we're going to sell to open a new call that's 30 days out, so it's in October instead of a September. So we push it out 30 days and we move it up like 3 strikes. So it gives us some breathing room, moves it up to a 1540, 1550. But there's 30 more days on the trade. Okay, so that is the risk. There's more exposure, time exposure. But we did move it out of the way, a little higher. So you keep on looking at all the analysis, trying to figure out, is this thing going to run out of steam? But at least that this is an option of doing an adjustment. Another option, let's say that we just believe this index is going to keep on climbing and it's not going to stop. Another option is we roll it out, but we flip it. We turn it from a bear call spread to a bull put spread. Okay, so it gets it out of the way, but it costs more money to do it, and you have to finesse it timing-wise in order to really do this where it doesn't cost an arm and a leg. But there's no free lunch. The minute you want to flip this thing and get it out of the way, either you have to flip it really close, where this is a lot closer up here, or really right on top of it, so there's a lot more risk. Or you have to pay, just pay more money. You have to pay $2.50, $3. So that what that represents is about a 20% loss or a 25% loss locked in on this trade to make the adjustment. But sometimes that's okay. We'll make it back in other ways. All right, so that's kind of rolling out and flipping the trade. So in this case, we basically bought to close and sold to close the original 1510, 1520 bear call spread. And we sell to open and buy to open the 1480, 1470 bull put spread. That's just an example, and it pushes it out 30 days. Okay, another option is convert it to a butterfly. And this is okay to learn and it's okay to teach it, but in reality they're very scary because you have to be right on both sides. So let's say that there's a sideways trending, underlying, and all of a sudden the thing moved on us. Well, let me just use this to show you what a butterfly is, and then we'll move to this, and I'll show you how we kind of created this butterfly. All right, so the butterfly is basically you sell 2 calls. In this example, this is a call butterfly. In this example, we have the 700 call. We sold quantity 2 of the 700 call. And then you buy the wings. You buy a 660 call and you buy a 740 call. They're all calls. This creates a butterfly. And let me show you how we would turn a bear call spread into a butterfly. So here's our bear call spread, and let's say it was the SPX 1520, 1510, 1520 bear call spread. We can turn it into this. Okay? So here it comes up. It's coming right up right to that point, well, guess what? I can turn that point into this point. But the range is pretty tight. Makes it pretty stressful to open up this trade. All right, so I had the 1510, 1520 bear call spread. I can sell to open an additional 1500, 1510. This is really a bull call spread right here. I buy to open the 1500 call, sell to open the 1510 call. That will cost money. That's going to cost a debit. I overlay that trade on top of this trade, and I create that. So I ended up with a SPX September 1500, 1510, 1520 call butterfly. Now you're at the mercy of the underlying index. It has to, this is a function of time. Now this just shows unrealistic days. It shows like 147 days out to expiration. I just picked this graphic up from somewhere. But usually you'll have 20 days left, 15 days left, and that underlying needs to stay right in this range, and as long as it's in here somewhere, you will actually book a profit. If it goes outside the range, you're going to have a loss. But sometimes this loss will actually be better than this loss. Okay, so that's just another way of doing an adjustment. Okay, so for adjustments, basically watch the technicals, including candlesticks, moving averages, volume, trend lines, past support resistance levels. Watch the VIX. If it really starts to climb from the time we opened our trades, a storm could be coming in, especially if the VIX is stair-stepping higher and not coming down. It stair-steps up, stays where it is, stair-steps again, stays where it is. That's not a good sign. That means that we could have some volatility coming and some craziness in the market. Watch the delta on your short legs. If they increase from that 10 range, remember we're trying to open up short. We're selling our short calls and puts near the 9, 10, 11 range for the delta. And if it gets up to 25, then you really need to start thinking about taking action. Okay, so we have lots of things in the Learning Center on adjustments. And but the ones I just showed you is really what we focus on, and I rarely do the butterflies. I mean, I really just either we roll up and out, or roll down and out, or we'll flip them, and that's about it because they just work more often than not. You do a butterfly, it makes it a little tougher because if it goes outside the range, then it was all for naught and it cost you more money to set it up and it didn't work. So in our Learning Center, we have a lot of information on doing adjustments. Okay. All right, let's look at the time here. I have 10 minutes left. Let's see. What I'm going to do is I'm just going to do a quick intro. I'm just going to finish off this material for the full hour, and then I'll stay on and answer questions for folks who want to stick around for the questions, because I'm sure we have questions coming in. But let me just go through this material pretty quickly, and then probably the next webinar I'll probably focus on this part. Not, the part that we just did was building the trade and adjusting the trade. I'll be having that. I'll do that type of webinar once a month, especially for beginners or people who want to learn about what an iron condor is and how do you adjust them. And then this piece I'm going to talk about now really is the most important part. And so I'll blow through it, and then we'll probably I'll do my goal is to do a webinar once a month on this part also. It's basically step 2, step 3. Monitor all the big picture indicators. And that, well, really it's just step 2. That's the meat right here. Other than step 3, it just basically says focus on a few underlying vehicles and we'll make a case of why. But for step 2, monitor big picture indicators, I mean that represents a lot of information. That's why our advisory when it comes out has about 75 charts in it each week. The reason is because we're trying to time when to open these trades and when to close these trades and or when to adjust these trades. So monitoring all these indicators is a really, really important part of all of this. Okay, so step 2, monitor big pictures of the indicators. Technicals, all right, price-based indicators, support, resistance, moving averages, volume-based indicators, market breadth. Macro, is the economy expanding or is it contracting? Corporate revenues, are they growing or are they shrinking? Top-line revenue growth. all the, and then of course timing things to the economic calendar, and then sentiment, volatility, money flow, sector rotation. So let's kind of do this really quickly, and then we'll have a follow-on where we can dig into this in a lot more detail. All right, technicals, price-based indicators, support, resistance, moving averages, volume, relative strength, market breadth. All right, so in our advisory, I basically dig up these charts every week. Takes us about 10 hours, up to 15 hours to do the analysis each week of looking at all the charts and figuring out where are we, and then trying to predict where is this market going to move over the next 2 to 3 weeks. And that's all we really care about for credit spreads. Because once we're right, after 2-3 weeks, we're done. We book our profits, or we close them out and try to keep our losses under control, preferably under 2-3%, and then we move on to the next month. All right, so for the industrials, we can see these are all fresh charts now. These are all just in the last day. So we can see the industrials have popped, found support at the 200-day line, up through the 200-day line, the 50-day line. We're back up to taking out all-time highs. So right now the bulls and the bears are battling it out, trying to figure out if they're going to push the Dow up through and if they're going to push the SPX, the S&P 500, up through. All these indicators right now are bullish, except for the Chaikin money flow. That's telling me there's something there that we don't see a lot of institutional buying pressure right now on this. But this could change over a week or two, so we'll see. All right, here's the SPY. We show the SPY here as a proxy for the S&P 500 index because I can see all these indicators down here. In general, very bullish. We did break up through. Today we just closed at 2,000. Now the question really is are we taking the next leg higher? Are we going up to 2,040, 2,050 over the next week or two? That's a tough one. I mean, volume analysis is telling me that we could, but just don't know. And then any type of geopolitical shock can stop it in its tracks, and that is always the risk. And that's unpredictable. We don't know what Putin and Russia is going to do, for example. ISIS is going to do. I mean, any of the type of geopolitical shocks that could stop, any type of uptrend in its tracks. Right now, if things remain quiet on the geopolitical front, all these indicators are telling me that we'll probably just grind higher for another week or two. SPX, interesting. The 100-day line actually represented some nice support over this last, couple of years, where this market has been trending higher. It found support right at its 100-day line there. That tells us something. That tells us that, all right, we're probably going to have a V, shaped rebound, and this could go higher, and it probably will. All right, for the NASDAQ composite, it's just one more thing we watch. This one already did break out along with the NASDAQ 100, so this is kind of pulling the market higher right now. Russell 2000 has been definitely lagging relative performance of the RUT as compared to the Wilshire 5000, which is really the broadest indicator of the market, or the broadest gauge of the market, is telling us the RUT is finally strengthening. I think it closed at above 1170 today. So we just picked up some puts today. We just brought in some premium, about 80 cents a premium, with some bull put spreads down here, just right at 1100, 1110. We were being patient, waiting to get confirmation that we're going to get break up through the 50-day EMA and SMA and get a couple closes at this level. We finally did. Relative performance also looks pretty nice, telling us that these puts are higher probability trades now. VIX, we're way back down to 12 again, in the 11 range. Boy, fear subsides quickly. That's just the way it goes when it comes to sentiment. Here's a bigger picture of the VIX. We can see it has been slowly taking out lower lows and lower highs. This one right here is a 1743 EMA, and it's pretty interesting to watch. I think it's one of the more powerful technical indicators that should be watched every month, once a month. That's what we basically do, watch it once a month. If you don't understand this after we're done talking about it, I would spend a little more time on it. In our advisory, we show it every week, but we don't update it every week. We update it just once every 3 to 4 weeks. This is the 1743 weekly EMA, exponential moving average. It basically tells you, are we in an uptrending long-term confirmed uptrend, or are we in a long-term confirmed downtrend? And this basically tells you when to get out of your broad exposure. So for example, in 2001, 2002, 2003, we could see that, and this is the S&P 500 we're using, The 17 EMA blue line was below. It crossed right around here in 2000, and it said, what that crossover tells you is that there is a high probability that the U.S. economy is going to start to contract, GDP, gross domestic product. And it's telling you that earnings are going to start contracting. That's what this technical indicator is telling you. So whenever you see this happen, that means you want to start battening down the hatches, start watching all your individual stocks. If any of your individual stocks start piercing down through the 50-day line, get out of them, sell, go to cash. And if you're a trader, then if you like to short or buy puts, then you can trade. But we're now in a high probability long-term confirmed downtrend. And then it tells you to stay out, especially if you're more of just the type that just goes to cash. Stay out, stay out, stay out until it finally crossed or crosses. 2003, that was May, June of 2003. It said get back in. Kept you in the market until January of 2008. It got you out of the market. It said stay out of the market until I think this was April of 2009. Maybe May or June, something like that. This doesn't look right. I've seen graphs zoomed in, and it actually was closer to April or May when it actually got you in. So that's the 1743 EMA. It's wise to start watching that once a month. This is the updated chart. Now this is using the NASDAQ composite, which is also a good proxy for the market. We can see that the 1743 crossed kind of mid-2009. Well, I guess it's June. Okay, it's told you to get in, stay in. This one now could be tough. Could have triggered people to get out. Got you back in, and they kept you in from January 2012 up until present. Okay? All right. Let's see, technicals. We just very quickly went through the charts. We didn't really get into price-based indicators, support, resistance, moving averages, volume. We didn't do that yet. All right, let's see. All right, let's talk about volume. Volume-based indicators. I personally like a tool called marketvolume.com, and this one basically looks at 1-minute bars, 5-minute bars, 10-minute bars of volume. What it does is it deconstructs the S&P 500 index, for example. It takes apart all 500 components, and it looks at the individual 1-minute ticks on those stocks, and then it tells you from minute to minute, or just depends on where you have it set. This one's set to 1.5-year or 1-day bars. These are 1-day bars, and it's telling you what the volume is, and if it's up volume or down volume, or volume on an up tick or volume on a down tick. And then they have these proprietary indicators. So it's just one more tool in the toolbox to give us a higher probability of being right when predicting where the market's going to go and where these indices are going to go. Right now, the S&P 500, based off of a longer-term 1-day bars, this is their main proprietary indicator called an SBB oscillator, and it's telling us that we're in a confirmed uptrend again. We're going up a little longer, at least for the SPX. All right, breadth. If you don't watch breadth, definitely put it way high in your list. This is very powerful stuff. The most simplest breadth indicators are, for example, like this one. This is the SPX A50R. You can get this from stockcharts.com. It's free. It's the S&P 500 index. It's the percent of stocks above the 50-day moving average. Okay? And we can see that right as of today, this is a fresh chart of as of August 22nd, 64% of the S&P 500 stocks are above the 50-day moving average. And that tells us a lot. And also when it starts rolling over, that tells us a lot. And then I put certain moving averages on here, and that tells me what's going on with certain indexes and what the probabilities of them pulling back hard or bouncing and climbing quickly. All right, so this is the S&P 500, percent of stocks above the 50-day line. Here's the NASDAQ composite, 50%, percent of stocks above the 50-day line. I'll tell you, for an index that looks so strong and broke out and is at taking out all-time highs, and only 50% of the stocks are above the 50-day line, that tells us something. This is not as strong as it should be. It tells us that just a handful, or all the big caps are climbing, but the other half of the stocks, a full half of the stocks are not participating in this bull run. That increases the probability that the SPX might stall at 2000, maybe up to 2005, 2006, 7, and stall. It could. That's what these breadth indicators are telling us. All right, here's the NASDAQ advanced decline issues. So this is the number of advancers minus the number of decliners on a daily basis, and then it's cumulative, so it just keeps on adding all the numbers up from day to day to day to day, and this is a very powerful indicator. So it just takes time. You just bring them up, you learn, use them, and then after a couple, at least 6 months of using them, up to a year, you start getting good at figuring out, all right, how accurate the data is and if it's really helping you. And the advanced decline data is very powerful. Okay, so that was breadth. I just talked about market breadth. We talked about the volume analysis. That was that marketvolume.com chart I showed you. And then I think we're going to have to wrap up here in just 2 minutes here. Macro data. All right, and so in the advisory each week we look at all the macro data that came out that week, and it ranges from 2 charts to 15 charts each week. So we're just watching all the macro data: jobs report, inflation, Philly Fed, initial unemployment claims, housing starts, credit, personal income and spending, retail sales. By the way, retail sales has been weak. That's not looking good. We'll see. We have to give it a couple more months to see what's going on with retail sales, but that's not looking good. ISM index, high yield corporate bonds, HYG is something good to look at. This is basically giving us risk on, risk off of people's sentiment of getting into risky instruments versus getting out of risky instruments. Conference Board leading economic indicators. By the way, a lot of this is in our Learning Center, and we show the links to these sites where you can get this information. Industrial production, seasonality trends. August and September, we're right in the middle of this right now. You can see that August and September are usually the 2 worst months of the year. And then once you hit October, November, December through January, it's just off to the races again. And then March and April are usually strong. Starts getting choppy through the summer. Sell in May, go away sometimes, even though July is pretty strong. And then September. Okay, capacity utilization. Here's the National Association of Home Builders. So this actually was a good report just in the last week. Overall, the data is looking pretty good. It's looking pretty good. The economy is expanding. GDP is probably going to come in at 3.5% to 4%. It's a very uneven, choppy rebound out of a really deep recession, but in general, the data is looking pretty good and the economy is expanding. All right, almost out of time here. Here's sector performance. We show this in the advisory each week. You can get this also at stock charts. It's called performance charts, and we're comparing everything to the Wilshire 5000. So we can see how the NASDAQ 100, for example, which represents just 100 of the big cap tech stocks, how it's performing compared to the Wilshire 5000, which represents the broad market. So this gives us insight into what's going on with sentiment, where money's flowing. For example, the mid caps have been improving recently, and the Russell 2000 has, I have a couple other charts that show it improving a little better than this right here. This one's long term, but in the last 20 days, the Russell actually has improved quite a bit. So relative performance is strengthening. And then sector rotation. Where's the money flowing? Cyclicals, technology, industrials, consumer staples, utilities, financials. And we can kind of see again how everything is moving in comparison to the Wilshire 5000. So it's a relative performance chart. And we can see right now technology has been outperforming, and so have the cyclicals. So that's telling us that it's reinforcing a confirmed uptrend. Here's a typical calendar we look at every week. We try to time things to the calendar. Sentiment, this is one provider we use, sentimenttrader.com, and it's just kind of giving us how overbought are things, how underbought are things, or oversold, oversold or overbought. So this is kind of one tool that we use, smart money, dumb money, things like that. So we don't have time for that. Okay, So we talked about learn the mechanics of building the trades, monitor the big picture indicators, trade just a few underlying vehicles. In general, just stick with a handful of the indexes and become an expert with those indexes. That's what it boils down to. And that is...
Those of you that are new to our service, if you haven't done so already, please check us out at www.monthlycashoptions, where you can also apply for a 30-day free trial subscription to the Iron Condor One Newsletter Advisory Service and learn more about our other products. Immediately following our event today, please kindly take a moment to fill out our survey before you leave. We definitely value your time and greatly appreciate your feedback. Thank you all for joining us here at Monthly Cash Flow Options, and that concludes today's webinar.